The Chinese economy is teetering on the edge of collapse, and this is not mere hyperbole but a stark reality. In the summer of 2025, the cold, hard numbers have sliced through the myth of a robust recovery. On August 15th, China's National Bureau of Statistics released July's economic data, sending a shiver through observers. Industrial output grew by a mere 5.7%, the lowest since November last year. Retail sales increased by only 3.7%, marking a new low for 2025 and a sharp drop from June's 4.8%. Fixed asset investment rose by just 1.6%, well below market expectations, while urban unemployment climbed to 5.2%, plunging millions of recent graduates into a harsh, jobless winter. These percentage shifts may appear minor, but they represent the livelihoods of tens of millions of families. Each year, over 11 million college graduates enter China's workforce, only to find the job market resembling a locked iron gate. They pound on it desperately to no avail. July's key indicators reveal the impact of tariff-related declines. U.S. tariffs have shattered the narrative of China's economic invincibility. Many hoped the 90-day extension of the U.S.-China trade truce signaled a turning point, but the data tells a different story. The average U.S. tariff on Chinese goods remains at a punishing 43.5%, and the U.S. Treasury is now planning punitive tariffs on Chinese products rerouted through third countries. This means that even goods labeled Made in Vietnam or Made in Malaysia cannot escape U.S. scrutiny. In the months ahead, this economic slowdown may intensify, potentially pushing China's economy toward a precipitous decline in the second half of 2025. China's economic engine, driven by investment, consumption, and exports, is faltering on all fronts. Investment is crumbling, with July showing declines in manufacturing, real estate, and infrastructure. The real estate sector is particularly dire, with new home sales plummeting and prices continuing to fall. Data from the eHouse Research Institute indicates that home prices dropped in over 65 of China's 70 major cities. Developers, drained of cash flow, are struggling to survive, much like patients in critical condition. Retail consumption grew by just 3.7%, the lowest rate this year. A decade ago, this figure consistently reached double digits. Now even major shopping events like Double 11 fail to revive it. Exports are equally troubling. In June 2025, China's export value fell 8.4% year-on-year, with exports to the U.S. dropping a staggering 17%. This is the true cost of the ongoing trade war. In response to this crisis, Beijing has not pursued large-scale stimulus but instead introduced measures like trade-in subsidies, consumption loans, and childcare incentives. The July Politburo meeting emphasized implementing existing policies, but these efforts may prop up a small business here or there without addressing the broader economic collapse. These figures should serve as a warning to policymakers, yet the problem is not a lack of awareness, but a lack of capacity to act. Amid this economic downturn, Beijing has introduced a new mandate. Starting September 1st, all businesses, restaurants, and self-employed individuals must pay social insurance for employees, rendering any private agreements to avoid contributions invalid. While this appears to protect workers, the reality is far grimmer. The Ministry of Human Resources reports that businesses must contribute 38% to 45% of total wages to Social Security. For small and medium-sized enterprises already on the brink, this is a crippling blow. Some businesses have simply closed their doors, leaving employees to arrive at work only to find their workplace shuttered. Restaurants are now hiring workers over 60, as retirees are exempt from Social Security contributions, reducing costs. On August 11th, a restaurant in Shanghai's Putuo district advertised for men over 60 and women over 55, requiring only steady hands for serving and stable footing. Such a job posting is heart-wrenching. Young people face unemployment while the elderly take up serving jobs. This is China's reality in 2025. More troubling still, paying into Social Security offers no guarantee of future benefits. China's population is aging rapidly, with the National Bureau of Statistics reporting that those aged 60 and older now exceed 300 million, over 21% of the population. This widens the Social Security funding gap significantly. Worse, reports have repeatedly exposed local governments diverting pension funds to cover fiscal deficits. Contributions made today may not be available tomorrow as China's public finances teeter on the edge of insolvency. Distrust is not limited to citizens. Capital markets are also signaling alarm. According to recent U.S. SEC disclosures, Bridgewater, the world's largest hedge fund, sold off its holdings in Chinese companies like Alibaba and Pinduoduo in the second quarter of 2025 while investing heavily in U.S. tech stocks like Nvidia. This is a clear vote of no confidence in China's future by global capital. In the first half of 2025, China's A-share market lost over 7 trillion yuan in value, with foreign capital outflows via northbound trading exceeding 160 billion yuan, a 5-year high. The bond market is also unsteady, with China's 10-year government bond yield falling from 2.6% in March to 2.2% in July, reflecting a rush to safer investments. Why? Investors no longer trust China's economic prospects. Major institutions like Bridgewater, BlackRock, and Goldman Sachs are divesting from Chinese stocks and flocking to U.S. markets. Capital, especially in tech and gold, is highly sensitive and has already detected the signs of decline. The Hang Seng China Enterprises Index, a key indicator of Hong Kong's market, fell 1.5% at one point, showing that international investors have lost faith in China's narrative. The data is stark, but daily life paints an even clearer picture. A July 2025 survey by Yikai Global found that China's Consumer Confidence Index hit a 20-year low, with most households choosing to save rather than spend. Kang Shifu's latest earnings report revealed a shocking 1.1 billion fewer instant noodle packets sold, with profits down over 20%. Instant noodles, once a staple for affordability, are no longer selling, signaling that people are cutting back even on the cheapest necessities. Urban youth unemployment far exceeds official figures. Last year, the National Bureau of Statistics ceased publishing youth unemployment rates as the true numbers were too alarming. Scholars estimate the actual unemployment rate for 16 to 24-year-olds approaches 40%, meaning 4 out of 10 young people are jobless. Social media has coined a new term, full-time delivery PhD. Many master's and doctoral graduates, unable to find professional work, don delivery uniforms and brave the elements. Some wryly note that they are China's most expensive labor force, with each delivery backed by years of education and significant tuition costs. Real estate, once the cornerstone of China's economy, is now its greatest burden. In July 2025, debt restructurings for major developers like Evergrande and Country Garden remain unresolved. The China Index Academy reports that real estate firms' total liabilities have reached 90 trillion yuan, nearly equivalent to China's annual GDP. New home sales have fallen 24% year-on-year, and second-hand home listings are at record highs. Many families find their homes unsellable and their loans unmanageable, turning dreams of wealth into chains of debt. In some areas, home sales have become absurdly cheap, likened to cabbage prices. In Henan, a developer offered 2 pigs or a new energy vehicle with a home purchase. In Shandong, second-hand home prices have reverted to levels from a decade ago. Falling home prices threaten not only developers but also banks, as real estate-related loans account for nearly 40% of China's banking system. A collapse in this sector could trigger a systemic financial crisis. As the economy declines, fiscal revenue shrinks. The Ministry of Finance reported a 5.6% drop in national fiscal revenue in the first half of 2025, with land transfer income plummeting 30%. Local governments desperate turn to borrowing. By June 2025, local government hidden debt is estimated to exceed 70 trillion yuan. Many counties face bankruptcy, delaying civil servant salaries. Some local governments have publicly urged residents to endure together, prioritizing stability over timely wage payments. The irony is palpable. Civil servants are running up debts at markets, teachers are queuing at banks for unpaid wages, and governments, strapped for cash, focus on maintaining order. To compensate, they raise corporate social security contributions, push consumption loan subsidies, encourage borrowing, and increase fines, targeting even small vendors. These short-term measures deepen the economy's downward spiral. In summary, when the elderly take jobs from the young, homes go unsold, pensions lack guarantees and unemployment soars, societal tensions grow like a snowball. In the summer of 2025, a trending online question asks, why are young people not marrying, having children, or buying homes? The answer is harsh. They cannot afford to, and they see no future. China's birth rate fell below 7 million in 2024, a historic low, and may drop to just over 6 million in 2025. This foreshadows a shrinking workforce and a widening social security gap. Meanwhile, divorce rates are climbing, reflecting an economic principle. As the economy worsens, families fracture. China is living this truth. If the past few years saw China's economy propped up by real estate and infrastructure, creating a facade of prosperity, that facade has crumbled in 2025. The US-China trade war was merely the spark. The true danger lies in internal debt, fiscal strain, unemployment, social security crises, and a demographic cliff. China is entering an era of comprehensive decline. The middle class is burdened by mortgages, the young are jobless, the elderly are forced back to work, public finances are collapsing, and international capital is fleeing. This is not exaggeration, it is unfolding now. China's economy may deteriorate faster than anyone anticipates. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.